Hello, I'm Caldwell, and this is On the Money, a weekly look how to get the best out of your savings and investments. In this episode, we're focusing on the investment prospects for China. Joining me to provide expert insights is Xiaolin Chen, Head of International at KraneShares, which is a firm that's a provider of exchange-traded funds, ETFs. So to kick off, could you explain what the main reasons have been behind China's stock market having a couple of tough years of performance?
Kyle, thank you for having me. I think it was most of the drivers that drive China capital market have a tough couple of years was macro-driven. So namely, some of the policies from domestically in China, policymaker making certain adjustments to regulations that impact the major private sector or industries such as e-commerce, internet companies, and they're followed by pandemic. They have a very strict measures to lock down the country for nearly 3 years' time. And at the same time, geopolitical tensions, geopolitical risks, trade tariff, anything you can name of, thinking from macro level, that macro factors that impacted any capital markets. Anything you can think of happened to Chinese equity market. And it takes a long time for the Chinese policymaker to deal one at a time to provide a solution or provide a path out. So that's really a main driver for the tough of a couple of years of performance of Chinese equity market.
However, there are some signs of optimism. Since the start of February, China's Shanghai Stock Exchange Composite Index, it's up around 10% at the time of this recording. What have been the main drivers behind that rally?
It was really the persistency and consistency from the Chinese policymaker of determined to get the market back on track. After a tough couple of years, they have been introducing accommodative monetary policy, namely cutting the interest rates, provide liquidities and provide fundings to any projects in trouble, such as real estate in China. And at the same time, they really start to spend, physical spending. They issued multiple rounds of ultra long-dated bonds in China to provide even long-term liquidity to the real domestic economy. So liquidity is rich, money is plenty, it's all in the systems. And next, what they did was corporates policies, reduce tax to help the industry back on track and stop or pause enough on regulation. That gave investors more confidence that have been doing that. They really means it, if we say. It's 5 quarters consecutively. They have been doing accommodative policy announcements for 5 quarters. That finally pays off, that investor realizing, you know what, the macro factor has been dominating, but maybe this is time to say the macro factor, all the different checks from a top-down perspective are checked on the green side. Hence, now the investor starts to look at the bottom up with corporate earnings. Is corporate really deliver good earnings? And the market rebounded on that basis.
Something that's caught my eye that I've read about, which I don't know anything about, is there are reports that there are this national team of Chinese state-linked investors that are employed to shore up the stock market with strategically timed purchases. Could you talk us through this and what are the implications for investors?
This is like a few years ago when the Japanese pensions start to buy their own equity market. Their ETF market shoot up in millions and billions, and few Japanese asset managers just experience billions of inflow overnight. They don't know what is really happening. So a bit similar action happened in China with the current valuation, with where it is now, and with all the corporates actually back on our foot to produce good earnings. The Chinese regulator realizing the market is just not where it is. Well, at least should be slightly better than where it is now. So the national team, the so-called composite, probably about 2 or 3 parties. One is the government themselves, right? It's called CIC, so it's Chinese International Corp. So it's basically government money. SAFE, who holds the FX reserve. And then there's another pensions, China pensions. So those 3, they call them the national team. So what happened to the national team was they initially announced, listen, we have 2 trillion, this is renminbi, but 2 trillion, they call them market stabilizing fund to start with. So you see, that's the point. 2 trillion to start with. What happened is they see, well, market correct for no reason based on macro headline news. And even though the fundamentals were strong, so they say, okay, we're going in and buy for pension money. So they came in again and again, a few rounds during earlier part of this year. And they pretty much used about 20 to 40% altogether at the moment. So about 400, probably 400 billion is used right around there. They have to declare after they did the purchase. So market never knows exactly how much 2 trillion gets spent. In my opinion, it's really a reconfirmation of the policymaker to say equity market have to consolidate here. It's unreasonable level. That's one. Second, there's a put being put into place in this market. So to me, that's long-term strategically positive for investors to consider Chinese equity market.
And as you've mentioned, one of the reasons for those purchases is the fact that Chinese shares are cheap. Could you talk us through this? How cheap is China compared to its history and compared to other emerging market regions?
Right. If you look at that historically, this is decade low level. Okay, that's one. But I give you another example. At some point, Alibaba need no introduction, is an e-commerce company in China. At some point when Alibaba listed, in New York, their market cap is less than the cash they have on their balance sheets. That's how oversold they are. Okay, and then you say, okay, it could be their earnings is not strong. Like, let me give you an example. Alibaba has been very solid in the domestic market, single high digits year-over-year revenue growth, which is good for a very matured market. Their international business, okay, 3 quarters before up 55%, okay, 2 quarters before 40%, last quarter earning release 66% year-over-year revenue growth. So revenue is there. Okay, and market cap values or performance of the stock still treated at such unheard of alarming level. So what happened is, with the valuation, with the growing of the company fundamentally, you would naturally ask one question: why don't you buy your own stock if you really believed it? And this is exactly what Alibaba has been doing over the last few quarters. They announced a couple of billions every time in the quarter earnings. They say, we're going to keep this cash to buy our shares back. Okay, Alibaba, Tencent, JD, all of them announced a similar program of share repurchasing program. At the end of the day, they have different time to decide when to buy, but they extended probably about 2 to 3 years altogether. Okay, from now, another 2 to 3 years. So 2026, 2027, up to them to decide when they plug. But at the end of the day, all the purchase, as if cut off today, Alibaba will shrink their shares by 14%. So think about how they believe in their own stocks with the current valuation, with the potential growing opportunity from their corporates are, extensively announcing repurchasing program.
So you explained earlier the reasons behind the rally that's taken place since February. Could you talk us through why you're optimistic on a 2 to 3 year view that there are better times ahead for investors in China?
In summary, this China market today, pressing anything but the upside. Let's put it that way. So you've gone through all the tough time with the Chinese equity market. At this juncture, China is cutting rates, providing the liquidity, giving a good corporate policy, at the same time encouraging the domestic market to pick up. For the corporate side, okay, they're back on their foot. They reopened for over a year now. They have this liquidity in the system that they can really leverage to expand their business. On top of all of this, China has one single market with 1.4 billion customer. Okay, you don't get this everywhere, anywhere. If the Chinese corporates focus on domestic market, it's already good enough for them to get higher earnings from here. And like today, where the valuation is for the Chinese corporates, anything, if you ask me strategically, this is almost like a perfect scenario for anyone to look at an asset class to invest from a strategic point of view, okay, to hold one single asset class. Chinese equity market almost take all the boxes.
And in terms of risks or headwinds, what would you say that could dampen that optimism?
I say geopolitical. Geopolitical is at least we've done one with UK election. Now we know clearly who's the leader that the Chinese need to deal with. There's a lot of election this year. We know that for a fact. And then China as almost the largest exports trading partner with almost every country, major economy in the whole world. It's important for them to know who their counterparts is to deal with that. I still think externally, the risks with new leadership, election in US, right around 3-4 months time, they need to know who their counterpart is to deal with that. But geopolitical risk can never be zero. There's always going to be a risk somewhere. The most important thing is for the Chinese policymaker to realize Okay, there is a risk externally. What do you focus on domestically to help your economy? Are you focused on them at all? So I was literally attending summer Davos in China. This was last week. They hosted in Dalian, a northeast city in China. I was there and I was listening to a speech delivered by Premier Li. Okay, China's Premier Li. He spoke for 20 minutes. Out of that, Kyle, he mentioned state innovation 35 times. So that just shows how determined the country is for the corporates to progress forward, period, the end. And he literally said he wouldn't be surprised and the government will do everything they can to support AI, clean technology, health technology, those three industry to become $1 trillion worth industry. So if you ask me, their intention is very clear. And they also mentioned repeatedly the potential risks they may face, but domestically we'll focus on ourselves. Can they do it with the base they have? Yes, they can do it.
And for investors who have or are looking for exposure to China, there are various options, including having exposure to its technology stocks, which is the area of focus for the KraneShares CSI China Internet ETF. Could you explain the outlook for that ETF? It peaked at over $60 in 2021, following the COVID boom that followed. But now it's just under $19. So it has been a very volatile couple of years. So could you also talk us through that?
You know, that fund is a classic victim of the entire, what we discussed, the macro risks that the fund has experienced with pandemic, regulation, and China recovery that exactly punish that fund's performance. Rightly or wrongly, we can hindsight judge. But that fund, if you look at their earnings quarter over quarter, this is really now start to show a sign of divergence of they actually produce good earnings, the fund's performance on the down. Okay, it's not really reflecting fundamentals, i.e. they not reflect fundamentals. That's one. Second, why we still have a high belief in that strategy? Because that fund literally playing an entire ecosystem in consumption in China for the 1.4 billion people. So when they spend $1, transit in the society, by the way, China is cashless society. Everything happens electronically. So when that happens, this fund benefit from it. Why that is important? Consumption is 40% of China's GDP. If China really want to grow that GDP back on track, that 40% got to perform. Okay, got to perform. And those e-commerce name, I apologize, the name is 10 years old, okay? But the fund's name is 10 years old. It's called China Internet, KWEB. But the underlying names of into that fund is not. Those are the leaders in e-commerce, in internet, in healthcare, in booking anything, even in AI. So that's actually representing China's next cutting edge. So yes, the fund had a very tough couple of years. Do we believe that to recover with anything that is set in scene today in China, that fund has to recover first. In fact, a lot of research houses such as CTs and UBS, they did their research. Okay, we don't work with them. They did their research. They come up with, if China rebound, which fund out of the entire market that is pricing in China will rebound, give you the most upside beta? KWEB, KWEB fund actually come up the top from their research. So if China rebounds, KWEB give you the most upside, obviously. So with where the valuation today, we do believe that fund has a huge potential on the upside.
My thanks to Xiaolin, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. And if you get a chance, leave us a review or a rating in your podcast app too. You can join the conversation, ask questions and tell us what you'd like us to talk about via email on otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website at ii.co.uk. And I'll see you next week.